Welcome back to PolicyCast. As India seeks to position itself as a preferred destination for global capital, the government has announced a series of measures aimed at deepening the government securities market and making it easier for foreign investors to participate. The reforms signal a broader ambition not just to attract capital, but to strengthen India's standing in global financial markets. To discuss what these changes mean for investors, markets, and India's growth story, we have with us Riaz Thingna, partner at Thornton Bharat, joined by Amit Kedia, partner at Walker Chandiok, who will help us unpack some of the key technical aspects of these reforms. Let's get started. Welcome to our PolicyCast series. My first question goes to Riaz. What is the rationale and background of the ordinance?
Thanks, Shilpa. In the face of global headwinds, the government is faced with a high cost of debt, fiscal deficit, and uncertain inflows. With this background, the government has announced a multi-pronged reform package to deepen the government securities or the GSEC market as we know it, and liberalize the foreign portfolio investments or FPIs. These reforms signal a clear strategic shift towards attracting stable, long-term foreign capital and aligning India with the global capital market standards. So India has historically faced under-penetration of foreign investors in debt markets. Most of the investments have been directed to the equity markets. The current circular reflects a policy shift to move towards a robust sovereign debt market and improve liquidity. The direction is to move away from volatile short-term flows and attract pension funds, sovereign wealth funds, and insurance capital.
Okay, so now that we understand the motivation and context behind these reforms, let's look at the specific changes introduced by this new ordinance. Requesting Amit to please specify what is the key change introduced by the Income Tax Amendment Ordinance 2026 and why do you think it is important?
Yeah. So on June 5th, 2026, the Government of India promulgated the Income Tax Amendment Ordinance 2026. This landmark ordinance exempts FPIs from paying any tax on interest income as well as capital gains arising from the investments made by them in central or state government securities. Before this change, FPIs were taxed on income earned from such investments, where the interest income was taxed, say, at the rate of 20%, long-term capital gains taxed at 12.5%, and short-term capital gains taxed at 30%, all but subject to any tax treaty relief. Now, with this ordinance being in place now, the tax rate has come down to zero, which drastically improves the net post-tax yield for the global investors and thus make Indian securities very attractive for investments.
So, taxing foreign investors at 0% on GSEC returns, it is a major incentive. So, please also clarify, when does this new tax exemption come into effect and are there any retroactive applications, Amit?
So, even though the ordinance was passed on June 5th, 2026, it has been brought into force retrospectively from April 1st of this year. This means that any interest income or capital gains earned by an FPI since the start of this financial year, which is from 1st April 2026 onwards on such securities, then they will qualify for the zero tax regime. Hence, any taxes which have been paid between 1st April 26 till date by the FPI on such securities, now they will be liable to claim the taxes paid as refund, or it could be used to set off against tax arising on any other taxable income earned during the year. The said exemption is obviously subject to furnishing of certain prescribed information in the manner to be notified by the Government of India in due course.
So, with the tax questions covered, including the effective start date and retroactive benefit, let's shift focus to regulatory measures that accompany this fiscal change, starting with the fully accessible route for GSECs. So, Amit, what major update has been introduced regarding the fully accessible route for foreign investors?
So, there has been a coordinated steps which have been taken by the Government of India and the RBI, where, on June 5th, 2026, along with the tax benefit stroke exemption, which we just discussed about, brought in by the Government of India, the Reserve Bank of India also made certain changes in its regulatory framework relating to FPIs. So, as per the said change, the framework for FPIs have been expanded, under the FAR route, which is for a fully accessible route. For people who are not aware what FAR is, it's a channel that allows non-residents to buy specific government bonds without any quantitative restrictions. The government has now officially designated, or rather the RBI has officially designated new issuance of bonds of 15-year, 30-year and 14-year tenure GSECs, as well as sovereign green bonds, which collectively will be called as specified securities under FAR, thus making them completely open to unrestricted capital inflow. These changes have been brought into effect from June 5th, 2026.
Clearly, Amit, by enlarging this universe of bonds that foreigners can freely buy, India is clearly sending a message of openness and confidence in its sovereign debt market. Now, let's discuss how the RBI has simplified FPI investment limits to complement these changes. How has the RBI restructured the investment limit framework for FPIs in government securities, and what is the significance of this reclassification for market participants?
Yeah, so the RBI has also restructured the FPI investment framework by merging the earlier general and long-term subcategories into a single unified investment limit for investments in central and state government securities. In addition, RBI has explicitly stated that with a view to provide greater access and ease of investments, it is decided to withdraw the requirement for FPIs to comply with the short-term investment limit, security-wise limit, as well as concentration limit for investments in GSECs under the general route. These changes simplifies the regulatory architecture, which further reduces fragmentation and makes the framework easier for market participants to understand and manage their debt portfolio. This is not merely a technical amendment. It is a regulatory signal that India is making sovereign debt access simpler, broader, and more investor friendly.
Understood. So, by rationalizing these investment norms, RBI is seeking to enhance FPI participation by making the framework more flexible and appealing. Beyond institutional investors, the regulators have also extended their focus to individual foreign investors. This brings us to my next question to you, Riaz. Has the RBI introduced any relief measures for NRIs, OCIs, and PROIs as well? If so, what are these measures and what is their broader impact on the market?
Well, basically, the RBI announced that the limits for investment by NRIs and OCIs in equity instruments traded on the stock market without SEBI registration having increased, and that the same facility is being extended to all individual persons resident outside India, the PROIs, at par with the NRIs and the OCIs. From a market perspective, this announcement indicates a policy move towards widening access to Indian listed equities for overseas individual investors. The same statement places this announcement within a broader set of measures intended to attract foreign capital into the country.
Okay, so now that we have covered regulatory and tax changes, let's evaluate the consequences of these reforms on the GSEC market itself. How would increased foreign investor participation affect India's government securities market, Riaz?
So greater foreign interest would boost the GSEC market liquidity and depth, as more buyers mean higher trading volumes and more efficient price discovery. An influx of foreign demand would push bond prices up and yields down, lowering the government's borrowing cost. Yields falling across maturities can lead to a flatter, more stable yield curve. Crucially, broadening the investment base diversifies risk and makes the market more resilient. Foreign investors currently hold only about 3% of the outstanding Indian GSECs, a very low share by international standards. So, more foreign participation reduces reliance on domestic banks and institutions. However, tax exemption alone does not guarantee immediate large inflows. Foreign investors will also consider current stability, global interest rate trends, and whether India gets included in key global indices, the bond indices, before significantly increasing their GSEC holdings.
So clearly, welcoming more foreign investors should deepen the bond market and help bring down yields and the borrowing cost. Finally, let's zoom out to the macro level to see how these moves might influence India's economy at large. So, what are the macroeconomic implications of exempting foreign investors from taxes on GSEC income?
Well, the move is expected to have positive macroeconomic impact. The government gives up some tax revenue, but since foreign holdings were small to begin with, that cost is limited. On the other hand, higher demand lowering GSEC yields could save the government considerable interest expenses, possibly improving the fiscal position over time. Lower GSEC yields also mean lower benchmark rates for private sector borrowing, potentially supporting credit growth and investment. Additionally, stronger foreign inflows would bolster the rupee, easing pressure on the currency and making imports cheaper, especially oil, which helps contain inflation. Stable or declining yields and steadier rupee would also help anchor inflation expectations. Finally, this measure reflects monetary and fiscal coordination. By attracting foreign capital, the fiscal side complements the Reserve Bank's efforts to maintain financial stability with healthier inflows. The RBI may not need to raise interest rates as aggressively to support the currency. A deeper, more internationally integrated bond market also improves the monetary policy transmission, meaning changes in policy rates translate more smoothly into market rates, reinforcing the overall economic stability.
Yes, so by significantly improving returns for foreign investors and making investment rules more flexible, the government aims to attract longer term global capital to India's debt market. And these changes not only promise to enhance liquidity and reduce borrowing costs for the government, but also contribute to a healthier macroeconomic environment, potentially lowering debt servicing burdens and strengthening the rupee, containing inflation, and improve monetary policy effectiveness. Thank you so much, Riaz and Amit, for the insightful explanation. And thank you all for listening to the discussion. We hope it provided clarity on the significant policy development. See you in the next episode.
Thank you, Shilpa.
Thank you, Shilpa. Thank you.